Hi, this is Diana Sescolini, and we're going to be talking about bookkeeping. We're going to do Chapter 5. These are lecture videos that I'm making for you. We're going to be doing adjusting entries in the worksheet. So let me park myself up here in the corner. So I'm still up here if you need me, guys, okay? So today, we're going to start talking about Chapter 5. Chapter 5 talks about adjusting entries and what we call, oops, hold on, guys. Let me get my little laser pointer here. Okay, here we go. Adjusting entries and the worksheet. This is called a 10-column worksheet. So the first thing we're going to talk about is how to prepare end of period adjustments. And we have to, when we talk about end of period, usually we're talking about the end of the month. We need to make certain adjustments. And the reason we have to make them is sometimes equipment wears out. Sometimes I prepaid things and now I've used them, like insurance and supplies. And finally, when I decide to do my month end, I may owe some employees wages because they haven't been paid yet because payday is not till next month. So I'm going to do adjusting entries. These are next to the easiest entries to do in accounting. They are journal entries though. And I'm going to give you a couple rules on this stuff in here. And I don't, if they're on my blue sheet, no, they're not. But I'm going to tell you some rules, so you'll be writing them down in this PowerPoint. So basically, we look at the principles we learned in the first few chapters. That revenue recognition principle says the revenue should be recognized when I earned it, regardless of when I get paid for it. So I actually have to do some adjustments to consider, was my revenue earned in this time period? And then we're also going to use matching principle that says I match the revenues earned in a given accounting period with the expenses incurred in order to bring my books up to date. So I'm going to use these two principles to do my adjusting entries. Now, in accounting, we talk about fiscal year. This is usually a 12-month period of time. It doesn't have to be a calendar year, but often it very well is. And so at the end of my fiscal year, I'm going to actually do some adjustments to my account. So fiscal year is nothing more than the period of time used for an accounting period. Again, it's usually 12 months, and it is usually calendar year. So the first thing we're going to do is we're going to talk about adjusting entries. So we're going to look at some of Damon's actual accounts. First one we're going to look at is his supplies account. So in the very beginning of June, or during June, he purchased $80 worth of supplies. These are assets. These are things I actually own. And when I did that, I debited my asset account called supplies. But during the month, I've used some of these supplies. And according to my inventory, I only have $20 left. According to my inventory, I have $20 worth of supplies on hand, but I started with 80. So I'm going to actually have to make an adjustment to correct the account on my books. Okay, so I need to make that adjusting entry. And here's what we're going to do. Here's my supplies account. So I actually use $60 worth of supplies. You always take what you started with minus what you have left, tells you how much you used. The amount used is what I'm going to adjust. So in this case, $60 has to be credited. This is the debit side, this is the credit side. $60 has to be credited to supplies to make my balance $20. Now, if I have a credit for 60, I'm going to have a debit for 60. So my debit's going to be supplies expense. This represents the supplies used during the month. So right now, get a sheet of paper, write these rules down. Hold on, let me pull up here into the next. Okay, hold on. Okay, so before we move forward, so this is one journal entry right here, supplies and supplies expense. Let me write down 3 rules of adjusting entries. Rule number 1, never involves cash. Rule number 1, it never involves cash. Rule number 2, hang on, I just forgot what rule number 2 was. Rule number 2 is it will always be dated the last day of the accounting period, whether it's the end of the month or whenever it is. So rule number 2, always dated the last day of the accounting period. And finally, rule number 3, it's a little bit longer, so you can pause this while you write these down. Rule number 3, it always involves a balance sheet account. It always involves a balance sheet account and an income statement account. So rule 3, it always involves a balance sheet account and an income statement account. So those are the rules of debit and credit. So this is the first of a few different adjusting entries. I'm going to finish them on the next video.